It's hard to breathe, but that's alright. Hush.
Okay guys, so moving on to the Fibonacci tool. We just previously spoken about momentum, so what we can do is go ahead and just clear that up because it's not really relevant anymore, because you guys have mastered that already, okay? But what I do recommend is, obviously, if you haven't, just go on the charts and start drawing up the data range and mapping out, you know, how long certain times and moves it took. So another complement is the Fibonacci tool. So you may be familiar with it, you may be not. But essentially the Fibonacci tool is obviously, you know, the way that the people use it is you got the 618, you got this, you know, 7 whatever, you got the 3 6 7 5, right, and all sorts of different numbers. But when we use it, all we have on is the 0, 0.5 and 1, right? So you can copy all these settings if you want. So I only have levels, background, the 1 is red, blue, and yeah, you can go ahead and copy that. And pretty much what we're looking at is in the blue zone, so the 0 to the 0.5, that is our discount zone. So when I say discount zone, you may be wondering what you want about. And the truth is, when we're looking to buy within a certain trade, so for example, if we're in an uptrend and I measure the higher low to the higher high and price pulls back, we want to be buying in the discount zone. So not only does this help invalidate POI, so for example, if there's an order block there, order block there, order block there, we wouldn't buy from any of them because it's not within this discount zone, okay? So when price pulls back into the discount zone, that's when we look to buy, and obviously somewhere in the discount zone is where we look to buy, pretty much, okay? And the reason why we buy at discount is, like, you know, when you go into your local shop, so for example, me, it's Tesco's, right? If I go into Tesco's, right, I want to buy things cheaper, right? So if I see a sale on, right, if for a certain something, if there's 50% off on a certain item, if I go into like JD or something and want a new pair of shoes, there's a weekend sale on JD, right, Black Friday, everyone goes mad over it. Everyone's going to be buying it because it's a big sale, right? So for example, when Black Friday's on, everyone goes crazy because they're getting things at a discounted price, okay? So why would we buy something that's expensive? So premium, if we move on to premium, why would we want to buy in the premium zone? Because if we're buying in the premium zone, it's expensive pricing. So I measure my discount zone and premium zone from the, you know, the high time frame structure. But you can also, if you've done that as well, you can also use it on the smaller time frames as long as it's within the overall discount zone on a higher time frame if we're looking for buys, right? Because remember, we want to buy it at a discount because it's cheaper pricing, and we want to sell it at premium because it's expensive pricing. So if we want to make some money, if we're selling a TV, we want to sell it as expensive as possible, right? So if we move on to this second chart here, if we measure the lower high to the lower low and price pulls back, anywhere as long as it's above the equilibrium is our entry, right? So within this range, this is our entry. So it's up to us to identify which order block is valid, which order block, or, you know, which supply and demand zone or which supply zone is valid, you know, which supply zone is being respected, blah blah, and what are the 1 minute opportunities we can take and stuff like that, okay? So yeah, so pretty much discount zone, it's like when we go to a shop, we want to buy it at a discount, right? We don't want to pay for the full price. And when we, you know, include this Fibonacci tool, the supply, you know, with the supply and demand, so the discounted premium, it sort of relates to the supply and demand. So if you understand supply and demand, this is simply supply and demand, right? So when you see, you know, the prices ranging, and you know, notices say equilibrium a lot. And if you refer back to the first video that we did on supply and demand in the last section, right, you'll notice how it was explaining off this chart, and it was like pretty much a chart like this, right, and it had the supply and demand, right, and when supply and demand be in the middle, that is called fair value, also known as equilibrium. So when we relate back to it in this, the Fibonacci tool, right, the 0.5 is our equilibrium. So equilibrium, I would say, is more, I use it more in the, like, when I look at my ranges. So for example, if we're looking at a Wyckoff phase, you know, it's good to understand the equilibrium of the range where the fair value is, because that's where the orders are being, you know, accumulated, right? So if you measure a lower high to a lower low, in the middle, you'll most likely see some sort of ranging, right? And that's where they're pumping their money into the market. So if price is just doing this, right, and say for example there's a high there, right, and there's a low over there, right, if I draw that a bit better actually, and there's a low over here, right, what we're going to do is we're going to draw up our zones. And also what you can do as well, you might need to reverse them from time to time, as they can be quite a pain to draw. But as you can see, right, if we draw on this, pretty much what I'm trying to say is if you see something like this, that's normal, because the equilibrium is where you will most likely see most, where the money is within a certain swing point, right? You're measuring it. Now the equilibrium can mean a lot of things. It's like, for example, if we're looking to buy or sell from a supply-demand zone, we want to focus on the equilibrium, right? Some people focus on the open, but if you want to focus on the equilibrium, that's fine, because usually price will, like we said in supply and demand, if price breaks out to the downside, so there's more supply, right, and price is looking to retrace, it's going to usually tap into the equilibrium because it's going to rebalance itself before selling off again, right? So it's like, don't overcomplicate it, just keep it, like, don't go too much into that, but that's how it relates to supply and demand. But just focus on just drawing it, you don't need to think of all of that stuff, okay? So the equilibrium is the equilibrium. It's just handy to have a part of a range. So for example, like you said, when we get into the Wyckoff section, I don't know if the Wyckoff will be in this course, I don't know if I'll do that. I haven't done that one yet. That one will be either in this course or in a separate course that obviously you get as well, but it might be released at a later date. But Wyckoff is, equilibrium. I use that sometimes just to, measure the equilibrium of the range, because we want to find the middle zone of the range, because usually the preliminary supply usually touches the equilibrium before leaving phase D or E, right? It's a bit more complex, but you'll understand when we talk about that. But yeah, so focus on the two things. Just if you want to sell, right, if you're within bearish structure, you want to sell at a premium, and if you're buying, you want to buy at a discount, right? And that's simply what we want to do. So again, it's very simple. I'm not going to go too much into that because it's literally so simple, right? So if we just measure the swing high, so this is where the initial move happened, right? But if you want to, that's absolutely fine. You can go ahead and, mark up this high like this. That's absolutely fine, right? But if you want to just be a bit more careful, right, you can just do this. When I say careful, I don't mean like careful. I just mean like you draw them how you want to draw. What works for you works for you. Because I draw them like personally, like where the move happened. But it's up to you how you draw them. But most people would just draw it up here, and that's absolutely fine, right? Because it's still equal. But as you can see, pretty much what I'm trying to get at is if we're looking to sell, right, and we see this order block here, right? So if we just go back to price, let's go there, right? And if we were to go back to price, people would look at this and think, oh, this is a supply zone, right? So what am I going to do? I'm going to sell from there, because this is the most recent before a break of structure to the downside, right? It's broken this structure. It's just the most recent. And while that does make sense, it's not lining up with our confluences. So what I'm trying to get at here is it helps invalidate a lot of POIs. So if we're looking to sell, anywhere within this blue discount zone, it wouldn't make sense. And as you can see, price came back up and just violated the structure, right? Seen a bit of range movement, and that's something we could just drag out until later on to see what happens, because this could be a respected level. Because if you look left as well, you can see that it's overall a respected level. So it's up to you what you do from there. But the moral of the story is that we want to be selling within the premium. So if we sell from here, right, this is the most recent one within this premium zone, and it just lines up with all this range lows, right? So it's like classical support and resistance. So this looks like a nice, nice trade opportunity. And as you can see, price then just sold off, right? So that's pretty much what we mean when we look at the supply and demand. Using the Fibonacci tool and just like want to sell at a premium, buy at a discount. That's what we essentially mean. But yeah, all you got to do is just measure the swing high. So for example, if you measure this swing high to this, whatever, this low here, let's say for now, right? If we want to sell above this line, right? So if price taps into above this line, we can look to mitigate this order block and look to sell from it and target the downward move, right? But in this case, obviously price set a new low, broken that range, so we create a new range. So we're now in this range. So what we could do is go ahead and draw Fibonacci tool from this high to this low, right? And you got an order block here, and which price is tapping into at the minute. I personally don't think it will, because as we just spoken about momentum, we were expecting price to increase based off momentum. So I wouldn't take the trade anyways, just because of momentum. So this is why it's important. But you got an order block there as well. So if you want to monitor these two supply zones, you got two valid supply zones, and you've also got a breaker there as well, which you could monitor. But what I'm trying to say is, guys, if one of the confluences don't add up, so for example in this case, even though the Fibonacci tool makes sense, right, and we're looking to sell from here, right, it doesn't make sense because the momentum tool that we use, the data range, the momentum isn't there, right? It's much more bearish momentum, so this tells us that price could push up higher. But if there was much more bearish momentum, then yeah, I probably would look to take a trade from here, right? I'll drop down to the 1 minute time frame, look for those breaker structures and stuff, okay? But yeah, you get the idea, guys. It's literally just, you're drawing swing points. It's like if you want to look in a bullish trend as well, that's absolutely fine, alright? So if we just reverse this, you can see here the price from the swing low, swing high, came back down, tapped into demand zone in this example, and ran away. Okay, so that's pretty much what we do, just to help find trade opportunities. And if price isn't pulled back to it, then that's fine. Okay, but if we look at this as well from a demand zone perspective, as you can see, this is a quick example of the equilibrium. As you can see, right, if you measure the swing low to the swing high, within the round, around the equilibrium, it won't be perfect, right, but around the equilibrium, you can see that price, what's it doing? It's just ranging. So these are just accumulating orders, right, in order for the breakout to the upside is more demand. So this tells us that we're, bullish. So what price did was, eventually it will tap back down into one of these zones, in which it did. Alright, so it tapped into this order block, or overall equilibrium of this sort of supply, I suppose you could say demand range, because if you look at this, right, you can, that's the high and that's the low, right? So if we were to take a trade based off that, we're buying at a discount. I don't know why I can't reverse that. There you go. So we're buying in this discount zone here. Even if we draw it from the top right, we're still buying in the discount zone. But we've also noticed where the large orders are being placed because of the equilibrium of this range, so it makes sense. Order block, right? And then even if you don't want to trade based off the order block, because off this order block you get a nice trade off the open, right? Because it lines up again with the overall equilibrium of this short-term demand range. Right, if price broke into the downside, then that would be a supply range in which we look to sell. But because it broken upwards, there's an order block within that. Right, there's imbalance, partially being tapped into. As you can see, this old range just lines up with the open of this order block, so it looks nice for a long opportunity. Alright, and our first target would be the supply zone. Why would it be the supply zone? Because that's where we're looking to sell from. Right, as you can see, price tapped into it and just ride it off. So if you've got a nice buy position, let's say from equilibrium of the range, let's do, yeah, because you could get the open as well, the order block, which is just a bit lower. But if we just do the equilibrium of the range, if your stops are below there, that's at 8.86%. If they're below there, that's still a 3.27%. Or if they're just below the order block, that's a 5%, right? But yeah, you get the idea, guys. Sorry to go a bit off topic there, but that's just a quick example. Right, when it comes to looking at the equilibrium of a range, that's what I mean. That's a good example there. And you'll see this throughout price, for when you mark up the swing highs and lows, especially a big swing high and low on a higher time frame. So this is the 4 hour, right? And this is the most extreme point, right? Rather than measuring out these minor structures, you ain't going to see much range of movement around the equilibrium there. But it just helps identify where price could potentially range in, because the equilibrium of of a swing high and swing point is where you should see the orders being placed into the markets, right? So it's just good to help us identify and understand. But yeah, that's the Fibonacci tool, guys. So you're buying at a discount, selling at a premium. And yeah, any questions on it, obviously make sure you ask me. And it's very simple. It just helps us the extra confidence in order to jump into a trade.